Welcome to a video that I call the deep dive video, and I feel I need to explain that. I use deep dive in a bit of a different context. Every week I do a number of videos. I do a video every day, I do a weekly video, I do an intermarket analysis video. After those videos, I go back and I look through all of the charts, mainly the daily charts, and I pick out those charts that I really didn't talk about, if at all, or maybe I talked about earlier in the week, but I'm not talking about right now, and I put them together into this video. I also have some other charts that are unique just to this video itself. I put them together and then present this video to kind of give you a bigger picture of what's actually happening in the market. This is being prepared for Monday, March 11th. The first chart is a chart of the VIX, and we use this for information. We don't really make decisions off of this. The VIX was designed to go between static numbers, 12 to the downside and 20 to the upside. And to a large degree, it stays within that range, but sometimes it goes outside of that range. So what I've done is I've turned the VIX invisible on this chart, but I still have a 50-period exponential moving average. And this sees what is the range over a longer period of time. This goes all the way back to about 2004. And when the market really runs into trouble, the VIX has a tendency to hit a higher range, like we did during the great financial crisis. Then when things were getting better, we settled down into a lower range. And then after the COVID plunge, we went back up into a higher range. And as the market has been bouncing back up and setting all-time highs, we've been establishing a new lower range, at least for right now. So we look at this, we want to know what is the overall context of what's happening with the fear gauge, and it does seem to be dropping off, which makes sense. As stocks are going up, fear tends to be less, and we see lower readings with the VIX. Another thing is we want to see how fast is the VIX actually moving. And what I use to measure that is an RSI based on 9 periods. When it's really going down quickly, we'll get an extreme negative reading with the RSI. When it's going up really fast, we'll get an extreme positive reading with the RSI. Right now, we're a little bit above 50 since we had a down day on Friday, since the VIX went up, but it's not giving us any kind of an extreme reading right now, so I haven't been including that chart. This is a chart that I was including for a while, but now it's dropped off because it's no longer really telling us anything substantial. I have a 5-period moving average of the VIX on top, and that's something that we look at every day. The area that I'm focusing on for this chart is a VIX to S&P 500 correlation. And when we get above this dashed line, that means that the market is getting quite nervous right now. We might not be seeing it in the VIX or some of our other fear gauges, but we might be seeing it here. We did spike up and then came down and then spiked up again. And as the market has been going up and then down, we've been dropping with this correlation down to an area that's not giving us an extreme reading right now. So I haven't been showing this chart. I did earlier in the week, but later in the week, I stopped showing it. Another chart that I stopped showing later in the week is called the skew index. When we look at the VIX, it measures things by looking at the money options that are close to the current price. The skew index looks at out of the money options, either above or below the current price. And when we get up into this red area, the market is expecting some kind of a big move. We came up, we came down, we went just barely into the red area again, and now we've been dropping, and we're below this red area, so it really hasn't been telling us all that much. It just means that the market is expecting something. And if you look at other times when we had this extreme reading, sometimes it was a top, sometimes a bottom, other times just a continuation. And since it's down here in more the neutral area, I haven't been showing this chart lately. And we look at the we look at the VIX, and then then we look at the VIX. Sorry about having to clear my throat. And we look at another indicator called the VIX of the VIX, the volatility of the VIX. And when this is going down, that tends to be more positive for stocks. When it's going up, that's more negative. Even though the market's been going up, we're seeing the VIX to VVIX ratio continue to go up as well. Then we look at some different studies. The MOVE Index tries to measure the volatility of bonds. The VIX measures the volatility of stocks. Here I have a little study showing the spread between the two. What I look at is on the bottom, the correlation between them. And we're seeing right now that they're having a real strong tendency to go in opposite directions, where a lot of the time they tend to go in the same direction. When we get a real high reading, that means they're going in the same direction at the same time. It could be up or down, but they're moving more in tandem with each other. When we get a really low reading, that means they're going in opposite directions. Then we look at ratio from the VIX to the MOVE index, and I look at mainly the moving average here. When this is going down, that's more positive for the market. But lately, since the beginning of 2024, this has been going up. Even though stocks are hitting all-time highs, we're seeing the VIX itself going up more, and that's why it's outperforming the MOVE index. Just a little bit of a concern, something we want to keep an eye on. Here's another fear gauge that we look at. It hasn't really been helping us all that much. We see more pronounced movements than what we've been seeing since the beginning of 2024. When this goes up, that means fear is increasing. When this goes down, that means fear is decreasing. Since we've been chopping sideways, I haven't been using this chart all that much. Another chart that is really decreasing as stocks have been going up isn't this other fear gauge. And we're seeing enough confirmation in some of our other charts, so I haven't really been bringing this one up much lately, but this just shows that fear is really decreasing. Then we look at a ratio between risk on and risk off, and sometimes this can be quite helpful. When this is going up, that means folks are favoring the higher beta stocks, the stocks that tend to outperform the market when we're going up. And then when we're going down, they tend to favor more conservative stocks, and we see this ratio going down. Since the beginning of 2024, we've been pretty much chopping sideways and not really trending with this chart, so it hasn't been all that helpful. We want to keep an eye on where are we when we measure back to the previous all-time high. We've now climbed 6.33% above the previous all-time high. This is just for information. Technical alerts are put out by stockcharts.com. I show them every day in the daily video, but this is the whole week taken together. And typically when we have an up day, this will be green or blue. When we have a down day, it'll be a lot of red. We read this from the bottom up. So the first signal back on Monday is at the bottom. The last signal on Friday is at the top. And when we are seeing how things tend to move in clusters here as the market is either going up or down. So we get kind of a high level view of are things turning more positive or negative each day. Also, Stock Charts puts out a thing called technical scores, and I base these on indexes. You can also put these on individual stocks or sectors or ETFs, but there are 5 main indexes that I follow. There's the S&P, which is the foundation of everything that I do and teach. Then we look at the Dow, we look at the NASDAQ 100, we look at the mid caps and the small caps, and then stockcharts.com rates them on a scale of 0 to 100. The higher the score, the better looking the chart. And we've actually seen some changes this week. Coming in first place are the mid caps, which really struggled earlier on. They come in with a score of 83.2, and they're seeing things a lot better. We actually set an all-time high with the mid caps earlier in the week. So they're looking pretty strong right now. In second place is what has been in first place for a long time, or the QQQs, which is the NASDAQ 100. It's been trailing off a little bit as we've been seeing some profit taking, especially with the Magnificent Seven stocks. We have 3 of those 7 stocks that are really under pressure right now. Apple, Google, and Tesla. They're really having some problems, and so that's biting into the overall score for the QQQs, but it's still coming in at 82.5. In third place is the S&P 500, which is what I focus on, and it comes in at 76.4. We watch the QQQs really closely because there's also stocks from the QQQs or the NASDAQ 100 that are included in the S&P 500. But since there's over 500 stocks in the S&P, there's also a lot of value that's in there as well. And that's why it tends to underperform. And it's coming in at 76.4. Then in fourth place are the small caps, and they've been really languishing now. They had a good week last week. They were the one major index that ended up being positive, but we never did really see the January effect. We saw things go really well in December, and then they just stopped in January. They are showing a little bit of an improvement here, but they're coming in at 69.1. And then in last place are the bluest of the blue chips, the real value companies. This is the Diamonds, which is the ETF for the Dow Jones Industrial Average. And it's been trailing off lately. Even though it's been setting recent all-time highs, it's coming in last place with a score of 53.5. Then I'll look at some short-term charts. And I look at all of this together. I try to focus on the very left and right of the chart all at the same time. And then I focus more on the right-hand side. This gives us an idea. What is the short-term trend doing? And this is measured by moving averages going from 10 periods up to 50 periods. Price is still above all of the lines, and all the lines are going up. So based on this chart, the short-term trend is really strongly to the upside right now. And we look at a double and triple exponential moving average study. This is based on 20 periods where price has been going up and the lines are going up as well. This is also confirming the short-term uptrend. Then we have some intermediate term charts, another rainbow going from 50 periods up to 100 periods. Price is above all the lines and all the lines are going up. So for right now, the intermediate term trend continues to be positive. Then we look at Bollinger Bands, and earlier on I did talk about this. The percent B indicator down below measures when we close either above or below the upper or lower Bollinger Band. And there's a lot of different ways you can use Bollinger Bands. Where are they within the band itself? Are they above the midpoint? Are the lines going up or the lines going down? We can look at the distance between the lines. This indicator just measures when we're outside of the upper or lower Bollinger Band. For the last number of trading days, we've closed inside of the band, so it's not giving us any kind of an extreme reading currently. Then we have another double and triple exponential moving average study based on 50 periods. And when the red line, that's a triple, that tends to move faster than the blue line, which is the double. That just shows that the intermediate term trend is still positive, even though we're closing down right in between both of these lines currently, as we saw a pullback in Friday's session. And we look at an anchored moving average. Now, regular moving averages, they look backwards. They go from the current price and then measure back. Where with an anchored moving average, you can go to a previous price somewhere in history, and then that shoots off a moving average going forward. And we're far away from this red line here right now. But when we were having some trouble last October, we did fall down below that, but we were able to hang on to that support, and we're bouncing up off of that. That's why I haven't been showing this chart. I have a couple of other anchored moving averages going back to some of the COVID lows. And as long as we're far away from these lines, there's really no need to show these charts or this chart. We look at a Connor's RSI, which is very similar to a regular RSI or pretty much any oscillator that we use. This is pretty spastic on a day in and day out basis. What we look for are extreme positive or negative readings. We're not getting that right now, so there's no need to show this chart. We look at a 50-period moving average study, and I plot both a simple and an exponential moving average. And price is above both the blue line and the red line now, and there's a pretty comfortable distance between them. So this is also suggesting the intermediate term trend is positive. We're also positive in the intermediate to long term. This is looking at the 100-period moving average study. The exponential moving average here is the red line, and that means that it's a stronger trend since the exponential moving average moves faster than the green line, and price is well away from both of the lines. So our longer term, intermediate term trend is also positive. Then we want to know how far away are we from the 200-period simple moving average. We got up over 13%. We're falling back a little bit, and there's some concern that maybe we're getting kind of far away from that 200-period moving average. Now, I have other charts that measure this, and one chart suggests that, yeah, we're getting kind of far away, but another chart is not really signaling anything right now, and I've been showing those in the daily videos. Then we look at standard deviation. This measures speed. It doesn't measure direction. It just measures how fast are things moving. And you can apply this to a stock or an ETF or a sector. And when we're down below the moving average here, that means that we're not moving all that quickly. Then we look at the mass index, and it's not generating a signal right now. We pay attention to this when it gets up to the red dashed line and the blue line, and we're far away from that right now. Then we want to keep an eye on the S&P 100, which are the biggest stocks in the S&P 500. And for the most part, they're confirming each other. They both have set recent all-time highs. They're both going in the same direction. We're not really seeing any divergences here. This is just a measurement that I do, so they may not be exact. When we hit those lows in October and then we started to bounce up, currently we're at 19.88%. We've been able to climb that much since those lows. We actually got up over 20% before the market had started to pull back. And we look at the CMB composite index, and earlier in the week, I did show this chart because we were getting an extreme positive reading. I used this like an oscillator. Then we dropped down, so I stopped showing this chart. And so we just use this like any of the other oscillators that I also go through. And then this is the Pring bottom fisher. This is really kind of a helpful indicator when the market's really going down and it looks like we're trying to bottom and maybe bounce up out of that. Well, since we've been going up, there's been no need to use this indicator. Long term, we have another rainbow going from 50 periods up to 250 periods, and the lines are going up and prices above all the lines. So the long-term trend continues to be positive. And this is the daily special K chart. I talk about it in every daily video, but I don't show the chart because we don't get many signals from this chart. The black line is above the red line, so on the daily chart, we are positive. However, we continue to be negative with the weekly chart, even though the market has been doing quite well. Then we look at a weekly chart of the S&P 500 on top and the German DAX, a weekly chart here, and we look at the correlation between the two, and right now they're having a pretty strong correlated relationship. Sometimes we can get some clues from Europe. If Europe's doing really well, sometimes that'll feed over into the US. If the US is doing well, sometimes that'll feed over into Europe. There are central banks that they do their thing in Europe. We have the Fed that does its thing in America, and sometimes they have a tendency to act in similar manners at similar times. And so we just want to keep an eye on what's happening internationally. And the German index, the German market itself is the biggest market in the EU. Then we look at the 10-year yield on top and we subtract the German 10-year yield. Since US rates are higher, that gives us a positive answer. We're above the red line here. And then sometimes we plot the US dollar index down here. Now, we don't sometimes plot it, we always plot it. But sometimes we can see a pretty strong correlation between the upper line and the middle line. Right now, it's not really showing a strong relationship with each other, so this chart really hasn't been that useful. Then this is the Hindenburg Omen, and this is what the perma bears, they love this thing. We did have an initial signal of the Hindenburg Omen, and there's a whole definition for how this is calculated. Stock charts, there are I believe three different things that go into a Hindenburg Omen. Well, stockcharts.com created an indicator that put all those three things together. When we're concerned is when we see a spike up, like we're seeing right here. But for this to be a valid signal, we have to see another spike up within 20 trading days. Well, this was generated right around the first part of February, and now we're coming up into the middle of March. So this signal has pretty much been negated now. But I watch this every day in case another signal is generated. We look at some different support and resistance levels. This is what I call a mini rainbow. It's a 20-period simple moving average of the open, high, low, and close. Sometimes when we're going up and we pull back, one of these lines may act as support. When we're going down and we bounce, one of these lines may act as resistance. We're above all of the lines right now, and the lines themselves are going up. So this is just suggesting that things are positive and we're not really getting any insight from this particular chart. And we look at the Ichimoku cloud. This is also support and resistance. These are a series of moving averages that are then shifted forward. Sometimes when we're going up and we pull back, the cloud may act as support. When we're going down and we bounce back up, the cloud may act as resistance. We're far away from the cloud now, so this really hasn't been providing us any insight. Then these are some possible fib retracements. We did set an all-time high earlier in the week, and I just readjusted these different retracement percentages here. In case we do start to fall, we'll be looking at some of these levels, but we're far away from even the first one now. So there's been no need to show this chart. But if we really start to see things go down, I'll be showing this chart a lot. Then we look at an arithmetic scale, and I know people like to get all fancy and say arithmetic scale. It's arithmetic. It's what we took in school. That's a little different way of shifting the chart. Usually most charts that we look at are based on a log scale. And that's what most of the charts that I show you, they're based around that. One day, just for kicks, I clicked it over to the arithmetic scale, and it showed me something that was kind of interesting at the time. I ended up drawing a trend line from the 2009 low to this low that we set back in 2010, and then I just extended that line forward. And you'll see that there are times when this is acted as overhead resistance. it really hasn't acted as support or resistance as we get further away. And lately, we're so far away from the line, there's been no need to really show this. Now, if we really start to come down, then this may act as some kind of a support level, but we're far away from that currently. And we have some broad market measures. This is the Vixen. Just love that name. The VIX measures the volatility of stocks. The Vixen measures the volatility of the NASDAQ 100. It's kind of hard to use this chart because of all this erroneous data on here. I mainly look at the line chart, but I pretty much focus on the VIX for the most part because most of my attention is drawn to the S&P 500. And this is a ratio between the QQQs, which is the NASDAQ 100, and the diamonds, which is the Dow. And they're having a pretty strong correlated relationship right now. We're getting a pretty high reading down here. And we want to keep an eye on the bank ETF, the financial sector, the regional banks, because New York Community Bank did come out with some bad news and their stock's just been getting hammered. We're wondering if any other banks are going to start to come out and say, we're having problems too. So for right now, though, the bank ETF has been going sideways and the financial sector has been hanging in there. It's in a pretty solid uptrend, but that could always change. We were caught about a year ago, kind of off guard, when a number of banks came out and said they were having problems, and that just sent everything going down pretty quickly. Here's the ratio between the regional banking ETF and the financial sector. And when this is going down the way it is, that means the regional banks are really underperforming, and they were doing better. And then the New York Community Bank news came out, and we've been falling back ever since. We're getting ready to see a potential death cross here with this ratio. Then we want to keep an eye on the transports. That's been a real disappointment. The Dow, the black line, that's been going up, and we're just coming off of recent all-time highs, where the transports at best have been just chopping sideways. That's not what we want to see in a good, solid environment. We want to see the red line outperforming the black line, even though they are on different scales. But we just haven't been seeing that lately, and that's causing us a bit of a concern because in traditional Dow theory, that is a negative divergence. But here's some positive news. If interest rates were really going to be a problem, the housing market is really, really interest rate sensitive. Do you think they'd be coming off of just setting all-time highs when you compare them to bonds? Probably not. So this is suggesting that interest rates are a little bit more friendly right now because this ratio continues to go up. Then we look at another ratio between staples, the things that you have to have even when the economy's bad, and tech, which is the best performing sector in the market. And when this is going down, that means staples are underperforming, which is not necessarily a surprise. I haven't been showing this chart all that much because we kind of know that. But if this really starts to act up or change direction or even have a counter trend bounce, we want to be aware of that. And then this is the financial sector, which is doing really well. It's going up. It's not quite back to setting all-time highs yet, but it's in a solid uptrend. The reason I have this chart is if we start to fall, we have a pretty significant line of support right here, but we're far away from that right now. Some rate of change charts, these are just for information. This is a 250 period rate of change, and it shows that we're going up, just suggesting that the much longer trend is still positive. Here's a longer look at that same chart, also recommending or suggesting that we are positive right now, but we're getting up above this blue line. And sometimes we can go higher than that, but this is where we want to get a little bit, take a little more notice that maybe we're getting a little extreme with the readings. We look at bonds. First, we look at 1 to 3 year bonds and we compare them with 3 to 7 year bonds. When this is going up, that means that there's fear that interest rates are going to keep going up. Then we hit a top in October, and this really started to come down. That's when we saw the stock market really going up very strong. Then after that happened, in the beginning of 2024, this ratio started to go back up. But lately, as interest rates have been coming down and stocks have been going up, we're seeing this ratio start to roll over again. So that's just showing that there's less fear about interest rates. The Fed has come out and said they're pretty much done raising rates unless things really change big time, and that they are likely to cut rates at some point in 2024. The market likes that. So when this is going down, that means folks are locking in the longer term bonds because they last longer and they're thinking that maybe they've topped out with their interest rates or their yields. Here's an inverse of that same chart. where this has been going back up, showing that the 7 to 10-year bonds are seeing more favor than the 3 to 7-year bonds, as folks are not as concerned about interest rates. But we've seen that before. We've been faked out. From October till the end of 2023, it looked like, yeah, everything's going to go great. And then it shifted. So we've been bitten by this idea before. We just want to keep an eye on this going forward. Then we look at another ratio between the long-term bond ETF and the S&P 500. It's actually, this is not a ratio, this is a correlation. And it's starting to improve, but they had been going in the same direction at the same time. But then we saw them really drop off as the red line was going up and the blue line was going down. But now it's starting to come back up. So their longer-term relationship is starting to get stronger again. And their short-term relationship based on 10 periods, this is also fairly strong, but not as strong as it has been in the past. We look at the QQQs and we do a correlation to the long-term bond ETF, where they were having a tendency to go in opposite directions with each other. And then I also have the spread between the black line and the red line. Sometimes this can give us some insight, but I mainly look at the correlation between the two. So they're still having a tendency, if the QQQs, meaning the NASDAQ 100, are going up, that usually means bonds are going down and vice versa. We keep an eye on the yield curve. The two ones that the market really pays attention to are these top two charts, the 10 to the 2-year and the 10 to the 3-month. They're underneath this red line. That means they're inverted, and they've been inverted for quite a while. If they go back to being normal, that usually begins the countdown to see if we're going to go into a recession. And on average, if we're going to go into a recession, it happens about 5 months or so, give or take, once we go back to being normal with these yield curves. And so that's why we watch this. Then we look at TIPS, which are Treasury inflation protected securities. This is what folks want to get into when interest rates are going up. And so the TIPS were outperforming the comparison that we make with the 3 to 7-year bond, because they thought bond yields are just going to go up and up and up and up. So why buy one now? I could just get a better yield at some point in the future. Then we saw a shift as this ratio was coming down, and then it's been chopping sideways. It has been falling down a little bit, but it's not as pronounced on this chart. We look a little further out where we're seeing a little bit more of a move here. When we hit the top in October and then started to come down because the market thought interest rates were as high as they were going to be at that point, and then it got fooled, so it started to go back up. Well, as interest rates have been coming down lately, we're seeing this ratio start to come down as well. That's just producing, for right now anyway, more of a friendly interest rate environment. Then we look at cash and we compare it to 3 to 7-year bonds. When this is going up, that means cash is actually outperforming bonds. When this is going down, that means that the 3 to 7-year bond is outperforming. It had been going back up, but is now starting to come back down, also confirming that we're seeing a more friendly interest rate environment. The market is pretty much banking on the idea that we're going to have a soft landing. And when we have a real high reading like we have right now, when we compare the S&P to 3 to 7-year bonds, and this is going up, that means that they are figuring that we're going to have a soft landing versus a hard landing, meaning with the soft landing that, yeah, we saw an economic slowdown and interest rates went up and things weren't all that great. And for individuals, the economy may not be very good, but we're going to be able to work our way through this without going into a recession. Now, there's still a big debate. You can look at a lot of charts right now that suggest we're going to go into a recession. You can look at just as many charts right now to suggest that we won't. And we don't, no one really knows. People are willing to offer their opinions, and they're willing to post chart after chart after chart, trying to make a case for their side. But nobody really knows that for right now. We just have to watch this unfold each and every day. Then I have a thing called the possible positive scenarios. This really played a big role in 2022 when we were going down a lot. And I broke out a lot of charts, and it would help us try to determine when we were bottoming and possibly going to see some kind of a bounce. I use some of those charts still in the daily videos because they can still give us some insight. But there are some charts that kind of come in and out of the videos, and that's what I show you here. The first one is the percent of stocks above their 200-day moving average. Now, I have another study that measures stocks inside the S&P according to their 200-period moving average. This is set up a little bit different where it works like an oscillator. When we get an extreme positive or negative reading, Also, I have a midpoint here. When we're above 50 and going up, that's more positive, and that's what we're seeing right now, but we're not getting any extreme readings, so I haven't been showing this chart, but I have been focusing on the other chart that's closely related to this. Then we break that down a little bit and look at the stocks above their 50-period moving average. We went to a real extreme reading right at the end of 2023. We fell back, and now we've been going up. We're also above 50, so we're still positive there. And to break this out a little more, we look at the mid caps, which are above 50 and advancing and had a good week this past week. And the small caps, they're doing okay, but they're the one major index that hasn't set an all-time high yet and have really produced a lot of frustration for folks. They're doing okay right now based on this chart. And then we have a 19-day exponential moving average of the advanced decline ratio. I usually use this like an oscillator to get an extreme positive or negative reading. When it's not doing that, when we're looking at this based on price and volume, if we're above 0, that means we're more positive and we're also advancing. So this chart is positive, but not necessarily giving us any extreme reading currently. And then this goes in and out of the videos too. Sometimes when the 2-year yield spikes and starts to come down, that will give short to intermediate term support to the S&P. Well, it really hasn't been doing all that much lately, so this chart hasn't been all that helpful. And then we also look at the Staples to S&P 500 ratio. We've been chopping around for the last few weeks here with this ratio, so I haven't been including this. But the idea here is to take a bigger picture look and see that this is declining. And when this is going down, that gives really good support to the S&P. It moves in the opposite direction. And if this continues to decline, that will give more support to the S&P. If it turns and starts to go back up, that could put pressure on the S&P. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. After this, I'll be preparing what I call the what to watch video, where this video talks about the charts I don't really cover that much. The next video, the what to watch video, goes through the charts that I'm really going to be focusing on, at least at the start of this upcoming week. So have a really good weekend, and I will talk to you in the next video.